So do you know if you can retire now? It's a question I get a lot from the people that I see. And in this video, I want to share with you how to think about if I need $100,000 of income in retirement, how much do I need to save in order to pursue my goal? But before we get there, subscribe to my channel. I've got over 30 years of experience. I want to share it with you, whether it's Social Security, retirement income, investing, whatever it is. I want to be your resource. So subscribe to our channel, hit the notifications bell so you're alerted to when we post new videos. So I say this over and over again, and I mean it. I think our industry has done a lousy job of preparing you for this transition into retirement, because so much of the conversation, so many of the commercials are about investing and beating the benchmarks and growing your money, when the reality is, when you go to retire, the focus and the importance of cash flow is so much more relevant and so much more timely to the pursuit of your retirement than outperforming the benchmarks. So I want to get into that for you right now. So I want to share with you a couple of stories that I think will give you a little bit of insight in terms of what not to do. The first deals with a prospective client that I met a while ago who was working with Fidelity while they were working and was about to retire. And he was getting somewhere in the vicinity of about a 7 or 8% total return on his portfolio. And when I asked him how much income he was going to take from his portfolio, he said, well, I'm getting 7 or 8%, so that's what I'm going to take. Well, I'm going to share with you, if you stick with it, why that is a horrible decision and a bad way to look at cash flow as it relates to your portfolio. The other story that I want to share with you, and it's more of a conceptual timeline of what happens before you retire, during your working years, and then when you retire, in your distribution years. And this is where we live. We live in the distribution years. In your working years, the accumulation stage. You're just looking to grow your money, right? So that you have enough of a nest egg to generate the income that you need. So you do take on a significant amount of risk, or for many you should, right? And it's okay because you have time on your side. You can overcome some of the mistakes, and that's okay. But when you go into retirement, into the distribution stage, the manner in which you invest has to be different. And again, this is where I think the industry's done a lousy job in educating you. You have to develop a risk profile for yourself going into retirement that is different than when you were working. And this is one of those areas that I think most people make a mistake, and I want to make sure you avoid that mistake. So let's talk about the right way to do this. So for this scenario, let's assume the people that I'm talking to are 62 years old, they're about to retire, and they need $100,000 of income. Okay, that's the base case. Now, when many people do this on their own, they focus in on that 100,000, but one of the mistakes that they make, and it's made often, and I see it a lot, is they miss one important line item: taxes. It's not 100,000 you need, you have to net 100,000. So oftentimes you are going to need more than the 100, depending upon where the money's coming from, which part of the portfolio, either retirement or non-retirement. You have to gross up the number. Just like with your Social Security you're getting, you gross up the number and then taxes are taken out. So remember, we're talking about $100,000, but it really is important to recognize you need from a gross number to generate more than that to get you that 100,000. Now I'm going to talk about 5 elements, 5 points that you need to consider when sort of making this decision for yourself. Again, we start with the premise, they're 62 years old, they need $100,000. What if you're 57? Because we really have to understand the time frame. Because if we say that these folks are 62, but I'm 57, well, we have to take into account inflation. Let's just assume a 3% simple inflation number. So when you're doing your planning, if you're 57 and you think you need 100,000 at age 62, then the number you really need, inflation adjusted, is about $116,000. And let's say you're 52 and you're forward thinking. You're thinking, well, in 10 years, I want the equivalent of $100,000 today, but we have to inflate that number out, right? So again, 52 years old, use a 3% inflation. Your number becomes $134,000 at age 62. So you need to take into account the impact of inflation. Second, the second item is you need to determine what's coming in. Is it pension, Social Security, and which of the 567 different Social Security claiming strategies are you going to employ? And before I get there, what I want to do is, out of my new book, Don't Outlive Your Money in Retirement, 7 Key Steps, we have the second chapter, which is completely devoted to Social Security. So I want you to go to my banner, click on the free chapter button, and I'll get you the free chapter. It will also get you all the information you need so that you know whether or not you're making the right choices and some of the frequently asked questions as well. So take advantage of this offer. So I'm going to get you how much you need to save, okay? But we have to go through these 5 points, these 5 decision-making items we've got to think about in order to come up with the number for ourselves. So we've been through number 1 and number 2. Number 3, you have to figure out where within the portfolio your money is going to be coming from. In other words, you may have your personal accounts, your taxable accounts, could be a joint account or on your own, but it's money that is taxable, versus your retirement accounts, which could be your 403b, your 401k, your IRA. And when the money comes out of there, it's very different than when the money comes out of the personal account, because typically you will pay more taxes out of your 401k, your 403b, and your IRA than you will out of a personal account, because all the money is coming out and it's going to be taxable at your current rate. This is, by the way, one of the benefits of having a Roth IRA, because at this point in time in your life, if you had established it earlier, the money would be coming out tax-free. Now, you also have to coordinate with your required minimum distribution, because at age 72, you're going to have to take money out of your retirement bucket at a rate of about 3.5%. So let's say you have $1 million in your portfolio. At 72, you'd have to take out approximately $35,000 gross and then net it out. So the fourth item, and it's really, if you will, the answer, okay? How big a portfolio do you need in order to generate the income? So let's go through some of the math, okay? We mentioned Social Security. Let's assume in this situation, there's no pension coming in. Most people don't have pensions unless they were working for the municipality, the government. They were a teacher, okay? So let's assume the household's going to bring in $50,000 from Social Security. And remember, we needed $100,000 net, but we have to add in taxes. So just as a general number, I'm going to add in a 20% number in terms of taxes, okay? So if you need $100,000 net that you want to spend, then you're going to have to generate, let's call it $125,000 $125,000 in order to generate the 100,000. Okay? So if you need $125,000 and you're bringing in $50,000 from Social Security, then you need approximately $75,000 to be generated from your investments. Now, in our industry, we have studies that go back a long ways that indicate that somewhere in the vicinity of 4% is the number that you can take from your portfolio. Remember the Fidelity study, the Fidelity prospective client, where he said he was going to take 7%? Well, this is where the wrong way is going to end up. He's going to end up more than likely depleting his assets, because the surveys show, the studies show over and over again for years in our industry that a 4% number appears to be the maximum amount that you should be thinking about taking out. Now, there may be certain circumstances where it's okay to take out a little bit more for a shorter period of time, but as a general rule, think about the 4% rule. So if you need to generate $75,000, how much of a portfolio do you need in order to generate that amount of money, assuming you take 4% out? That number is about 1.875, or in other words, about just under $1.9 million in a portfolio to generate for this particular couple at age 62, $100,000 of net income. Okay? So I know that's a big number. For many of you, you may not have it. So I want to finish this video with some choices that you might have, things that you might want to consider to solve the problem in the event that you don't have that kind of money or don't believe you can save enough money to grow it to the number that you need. Let's talk about what are your choices. First, you can decide to increase the risk with the portfolio depending upon the time frame you have until you retire, to see if you can get to that magic number, that retirement number, so you have a big enough nest egg to generate the income that you need. Second, you can accelerate more savings. You can increase the number that you're putting away. As you get closer to retirement, it's tough to make up what you should have done earlier, but it certainly can't hurt if you're going to accelerate that number. So that's a second choice for you. A third choice, delay your retirement. AARP did a study a couple of years ago. They indicated that a majority of people who were facing their normal retirement age, call it 66, 67, were deferring their retirement, and the number one reason was finances. So you may want to delay that retirement, may help you out a bit. The next item that you may want to think about in terms of choices is lower your expenses. Some of us may not want to do that. They may want not to consider that a viable option, but it may be something that you may have to take a look at. Another is, and we didn't consider it in this planning scenario, but this is where the retirement roadmap comes into play. This is where planning, true planning, conversations really get generated in terms of trying to find solutions, right? So another thing to think about is maybe you spend 15, 20 hours a week over at Home Depot or Lowe's or some part-time job generating some additional income for a period of time. And then finally, another choice is maybe you move to a cheaper location, a different state, where the expenses for the daily living aren't quite as high as where you are right now. So these are some of the considerations to think of. You know, we have the whole 7-step process that we take our clients through. Why don't you take a look at our playlist and see what that is all about?